To itemize or not to itemize? That's the $1,000,000 question today. Hey guys, my name's Andrew, partner at Ledgerly with my good friend Mike. Today I'm going to be taking you through itemized deductions and the standard deduction. What do those mean? Should I be taking the standard? Should I be itemizing? What's included in itemizing? And if you're completely lost, we'll take a step back to start. But that's a brief overview. Please hit subscribe so you can stay up to date on tax tips and videos on tax strategy, where Mike and I talk through at length the details and try to educate you and our clients on how it could benefit you. So that's enough of that. Let's get to the whiteboard back here. So I've drawn up a few things. Now, on the left, we got the standard deduction. On the right, you see I have Schedule A. That's where itemized deductions go. Now, even take a step back even further. Itemized, standard, deduction, what the heck is he talking about? I'm talking about for anybody filing a Form 1040. Anyone in the US making money who has to file an individual income tax return. That's what this topic pertains to. Now, everybody's offered what's called standard deduction. This standard deduction on the left is available to anyone filing a 1040. Again, that's the form you fill out when you're doing your own individual income tax return. Now, the IRS says like, hey, you could either take what we give you over here on the left, or you can gather all your expenses yourself, again, that are under Schedule A, which is an attachment to the 1040 return. You have to fill out Schedule A for all the different line items and then tally them up. Is it greater than these numbers over here or not? That's going to tell you everything you need to know if you should be itemizing or not. But every taxpayer filling out a 1040 can do either or, but you can't do both. I'll bring up why that's important later. But let's go over the simple one first, the standard deduction. So why do I have different amounts if they're giving everybody the same thing? Well, they're not. It depends on your filing status. So if you're like me, you're single, i.e. you're not married, you are allowed to take a $15,000 deduction from your adjusted gross income. So this is not a dollar for dollar reduction in any tax you would owe, any tax liability. It's a deduction, which is then ultimately used to get down to your taxable income, which then the tax is assessed on. It's not a credit. It's a below the line deduction. So again, me, single, I get these are 2025 rates. I can have a $15,000 deduction. If you're MFJ, married filing joint, you have a spouse and you guys file your tax return together, you have that $30K. If you're married, but you decide it's beneficial, or your tax preparer says like, hey, you guys might want to file separately, you can both file separately. MFS, married file separately. So that's 2 tax returns. The benefit gets cut in half. So you're not together, so same rate as the single. 15K. And then HOH, head of household, that's another filing status. That's for your single parent who has a dependent living at home. That's the most typical scenario. They have a standard deduction of $22,500. So that's standard in a nutshell for 2025. Simple. Now we get over here to Schedule A. Like I said, it's an attachment. So on that form that you're going to put with your tax return, again, if you're itemizing, there's going to be a bunch of buckets of deductions that you're going to have to tally up, fill out, see if it makes sense. So there's 4 big main categories of deductions that you see on Schedule A, and I have them listed here. SALT, state and local taxes. And those taxes could be income taxes, personal property taxes, real estate taxes. But you see I have in the red there, 10K max. You can't get a deduction for anything greater than $10,000. So if you racked up 30K in taxes, in state and local income taxes, sorry, I can't really help you there. The way the code is written currently is it's capped at 10,000. Now, there are some discussions with Trump's bill. This number may go up, which would be massive for taxpayers. Current State of the Union, 10K. Moving on, you have mortgage interest. So this is for your homeowners who have mortgage on their home. They pay interest on that loan every year. So you can deduct the interest, but only on Schedule A as an itemized deduction. So if you go through all the math and you own your home, you have home mortgage interest, maybe it makes sense to itemize. Or if you got locked in at a really low rate before the housing market blew up, maybe you got in a really low rate, your interest isn't that much, maybe the standard makes more sense. And you'd find that on a 1098, Form 1098 MIS. Charity, charitable contributions. Are you a giving person? Do you contribute to your church, your college, your school, your town, whatever? Charity. Giving money to charity. And this could be even goods that you donate. I say goods, I mean like old clothing, old furniture. If you get over a certain dollar amount though, you're going to have that vetted by whatever institution you're donating to. And you'll need to make sure you have that receipt so you can back up and ultimately take that deduction on your Schedule A. There's an additional form you got to attach with it and fill out some information, but you could do it whether it's money or if you're giving away things. And then last down there, again, we have some red, so you know there's trouble. medical. Now, yes, you can take medical as an itemized deduction, but only if it's in excess of 7.5% of your AGI. Now, what the heck does that mean? Let's have a simple example. So let's say, oh, get low here. I have 100K AGI. Cool. I know my limit for medical is it has to be in excess of 7.5% of my AGI. So what is that? For those of you following at home, 7.5K. Now it has to be in excess. So let's say I had 10K in medical expenses. I could take 2.5K as an itemized deduction. That first 7,500, it's lost. Go back to our YouTube page. Mike just did a great video on the HSA, and that's what we highly encourage taxpayers and most of our clients to get involved with, because that has a triple benefit. But listen to Mike's video to learn more. That's the smart way to go about writing off medical, because you don't get trapped on Schedule A. It actually goes to a different schedule where you get the deduction. And again, I said these are like the 4 main categories on Schedule A, but there are some others like casualty and theft losses. You have to fill out an additional form, and it needs to be like qualified disasters, those sorts of things. Doesn't happen to the normal everyday taxpayer, but it does happen. It could benefit you on Schedule A. And then also this other category, this other miscellaneous deductions category, that has actually been disallowed as part of the Tax Cuts and Jobs Act back in 2018, but may come back in the future. But as of right now, in the year 2025, that bucket of deductions on Schedule A, not a thing. So now that hopefully all of you are with me, we're going to go through a little example here. As long as my board doesn't fall down, make sure you remember this. Technical difficulties. All right, so now we're going to go through an example. I'm going to use Mike and Andrew, i.e. the partners at Ledgerly. All right, so what do we talk about? What are the important things when you're itemizing? We need to know your AGI, because that's going to come into play for the medical. Then the other big buckets, right? So we already got the medical. Then up here, that's SALT, that's state and local income tax. You have the MIS, the mortgage interest statement, then charity. Those are the 4 big main buckets. So when does it make sense? Itemize or take the standard? Let's say, Mike's a smart guy, right? Let's say he had a great year. He's reporting 200 in AGI, 200K. Me, I got a mullet, mustache, not a lot going for me, but let's say like I scrapped together 100K, right? Not bad. Certainly enough to live off of. Then state and local income tax. Now, he's got higher dollar amount maybe on his W-2, so he's going to have some higher withholdings on his for the state income tax. And let's say Mike's a homeowner, which he actually is. Congrats, Mike. Got a house last year. So now he's got some real estate taxes, and then personal property taxes. Again, those are all encompassed in the state and local taxes. So let's say he came up with 15K, and me, I rent, so I don't have any real estate taxes. I had lower income, so not as much withholdings. I don't know. Let's just say I got like half of that, 7.5K. Mortgage interest. He got a new house last year. I don't know the details, but let's say it came out to about like $20,000, especially in this market. Houses overpriced, high interest rates. Yeah, let's just do a safe estimate of 20K. And me, what did I say? I rent, so I get no mortgage interest. Charity. Mike goes to church. He plays in the band for his church. Like I said, nice guy. He's making contributions. He contributes 2K. Me, not that I'm not a nice guy, but I'm not a nice guy. Medical. Make it simple. Mike's got, he's a healthy guy, but you got to go to the doctor for an annual physical. You got to go to the dentist. Dental counts under medical. Maybe he had a surgery. I don't know. Somehow he had 7.5K of medical expenses. And for me, let's say I'm an athlete. I'm rumbling and tumbling in jiu-jitsu. I got hurt. I had to go to the doctor a few times. Let's say I had 10,000. I apologize for my dollar signs, but you get the idea. For this scenario, we're going to consider us both filing single. Mike is married. Sorry, ladies, but just for the example's purposes, we're both going to file single. So now let's tally up our itemized deductions. So what did we say before? State and local income taxes. It's capped. Here, another color here to help you guys out. We said it's capped at $10,000. So sorry, Mike, you're not going to get the full 15. Mortgage interest, there's no limitation on that. Well, there is if the outstanding loan is too high. There's actually a reduction, but we're not going to talk about that. Keep it simple. He's going to get the full 20 in my example. So he's got 20. Charity, no limitations there. So he's got 2. Medical, I'm not going to write it out, but again, it has to be in excess of 7.5% of AGI. 200,000 in AGI. So what's 7.5% of that? It's going to be 15,000. Again, the math I did before, 7.5% of 100,000 is 7,500. You double that, you get 15K, but he only had 7.5 of medical. So he's not going to get anything down there. But you can see when he itemizes his deductions, look at that, 32K. Bang, bang. Now for me, I look like a lost cause, but I'm under the SALT cap limitation. So I'm going to get that full 7.5. And then my medical, 7.5%, 7,500. I'm going to get 2,500 because again, it's the excess. 10,000 minus this 7,500 $2,500. The first $7,500 is lost. Again, watch Mike's YouTube video on the HSA. All right, so Mike racked up quite a bill. I did not. If you remember, the standard deduction for a single filer is $15,000 in 2025. Mike's got $32K in itemized, so he should be itemizing and going on Schedule A. So we're gonna say itemize, but my sorry, you know what? I didn't make the cut, so I am going to take the standard. And that's the math you gotta do in your head. Talk with your accountant, your tax preparer, your CPA, your advisor, whoever. Talk to someone educated. Educate yourself. I mean, watch this video over, look it up online, but you can see how you can rack up quite a bill and you should be itemizing. You don't want to, you're entitled to take these deductions. There's nothing fraudulent or illegal about it. You're entitled, it's in the IRS code. You can itemize. Like I said, you can't take both itemize and the standard. It's either or, but do your homework, do the math, crunch the numbers, see what makes sense for you so you're getting the most benefit at the end of the day. That's all I got for you fine folks on itemizing versus the standard deduction. Please like, comment, subscribe to this channel to learn more tax tips and stay up to date on tax strategies so we can help educate you and put you in the best financial situation as it comes to your taxes.